Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Corn futures have been range-bound since August 31st, and that continues to be the case to date. If we look at the first series of sideways congestion, we can see from August 31st all the way through till mid-November, the market found very good support near 355 and very good resistance near 375. From there, the sideways movement made a shift, and we can now see that previous support became resistance near 360 to 365, and now we currently have very good support sitting at about 345. Until this market's able to break outside of this range, we anticipate that this continued sideways motion will continue, and for now we're looking to the end of January for a potential threshold where the sideways congestion will finally terminate. Most recently, we've had two standard deviations below the point of control coming in at 353, and just over a couple days ago, the market once again tested that level only to reverse to the downside once again. The market did manage to break previous lows over the last couple of days, and right now we're looking at support near that 342 to 343 area. If this market does break below this number, we think that 340 should hold very well, and we're looking for the sideways congestion to remain somewhere inside of 340 and to perhaps max out at about 370 going forward. Again, we're looking at the end of the month for a potential exit from this sideways congestion, and until then, we continue to monitor the markets. As noted previously, the recent lows did happen to coincide with the 347 half number, which is 360-degree mark of our cycle. And just below, we have volatility-based support coming in near that 345 mark. It's no surprise to us that the market did find very good support here. Additionally, we can see that our time factor did happen to post a very good low for this market, and from there we see a very nice bounce. Directly overhead, we do have our volatility bands coming in with 358 to 362 as potential resistance. So in the event that the market's able to break to the upside, we do think that the first test of this area should pose good resistance. The price action for the May contract is obviously very similar, as we can see on the chart. Overhead resistance coming in at about 365 is where we think the market could very well be halted in terms of its sideways movement. And to the downside, we can see where 355 was very good support. And in the event of breaking down below 355, we anticipate that the market probably won't get much lower than 350. Besides that, we do continue to feel that the sideways congestion will continue for both the May and the March contract, and we'll simply continue to monitor its actions going into the end of the month. The top end of volatility-based support for the May contract sits right at 353 half, and just below that we have our 360-degree mark at 351. Both of these areas look to situate themselves as very good support for this contract, and overhead we do have our 364 3/4 as potential resistance. Now, once this market is able to get above this 364 3/4 number, the next area of resistance sits at 370, and that's 370, as we can see here, also happens to coincide with our volatility bands as they're making their way down. As the volatility bands actually continue to make their movements, they are narrowing more and more, which basically means that as these markets come together and perhaps towards the end of the month, once it's finally able to break out of this narrowing band, we're potentially setting up ourselves for a very nice explosion on either side of the market. And right now we're anticipating to the top side for this contract upon finally terminating the sideways congestion. July beans has been moving very nicely, finding key support on the 12th right up against our support down below at 365. And now we're seeing that resistance overhead that had been holding up could potentially hold up one more time. Upon breaking this 995 to 997 area, the $10 mark is perhaps in the cards for this contract, and we can see a very nice move to the upside after having been in a small consolidation sideways, with a nice breakout to the downside, which emulates the capitulation of the sell-off, and a very nice reversal off of the low with the market reversing back up again. If resistance near this 997 mark does hold, we're looking for the market perhaps to continue moving up through the end of the week where we have our next time factor coming in. Upon doing so, if the market moves back down but is able to hold and stay above that 980 mark, we do think a very nice move to the upside is ahead for beans, and that appears to be what's shaping up for this contract at this time. What we find for this July soybean contract is that the market had been trading inside of volatility-based support for quite some time. We got that nice breakout, and if you recall from previous sessions, we talked about the importance of the 980 number. The market broke down below this number for about 2 or 3 days, but was able to stabilize and return back above the 980 threshold that we had talked about. The market now is back inside of volatility-based support, and upon doing so, if this market now is able to break out of this area or out of this zone, the next key opportunity for potential target sits at $10.10. Upon reaching $10.10, we could see some resistance here, but somewhere between 10.10 and 10.15 looks to be a very good resistance zone for a nice little pullback. And once that pullback happens, if the market comes back in and holds and finds support perhaps at that 995 to 990 number and then turns back up, we're looking at a very nice move to the upside potentially for soybean futures. From December 12th all the way up through January 3rd, wheat futures had been moving up very nicely, giving us a nice advance as anticipated after having responded to the divergence that we had seen in the price action previously. Over the last 2 days, however, the market did show a very big move to the downside and surrendered almost all of the movement to the upside basically over the course of 2 days. The last 2 days, the market has managed to rebound some and did not break the previous low. And now we're back above the 360-degree mark at 424 that we've been discussing time and time again. As long as this market's able to finish this week above this 424 number, we believe that additional upside potential still does exist, but that 424 continues to be a very key level for this contract. In the event that it closes below this 424 number, we would then be looking for the market to make one more marginal break below the 410 number and giving us a close somewhere in the neighborhood of 400 to 405 for a potential final low. And from there, we can finally start to see a potential advance to the upside. The next time factor for the March wheat contract rests on Friday, January 19th. So what we would be looking for now is for the market to potentially continue to move up into the 19th, perhaps on Monday and Tuesday as well. And from there, if it does find some resistance and turns back down, once again, that downside target of about 400 looks to be a potential final low. And from there, we could start to see a potential nice move to the upside. We'll close out our session today with the US dollar. And as we can see from the consolidation sideways that we had seen previously, our predisposition to continued weakness has come to fruition. The market made a nice move to the downside. And as we can see here, part of what occurred is a mirror movement from the move coming into the market, replicating itself back out on the other side. Hence, we can find a near-term target coming in at $90.36. And upon reaching that level, we can see exactly where this market found a bit of a bounce and has consolidated since then. We anticipate that the US dollar could in fact have continued weakness, and our minimum price objective target of about $90 is very close to being hit. So despite bouncing right at the one-to-one correspondence, the dollar continues to look like it wants continued downside action. And from here, we're looking to see whether or not the market makes it to 89 or even lower. Taking a look at the longer-term weekly contract, we can see how going into January 2016, that the US dollar had been on a very nice, strong tear to the upside. It topped in January 2016, and from there, it's been on a very strong downside decline. We have the first leg of that move coming in where we've labeled it as leg A. We have a very shallow pullback that came in that we labeled wave B, and now the market continues to move to the downside, and this is where we have potential support coming in near our wave C area. Now we do have volatility-based support coming in the neighborhood of $86 to $87, but if this market breaks through the 86 price threshold, we could be looking again at a potential one-to-one correspondence where we see the move to the downside coming off of that wave 5 high could replicate itself back down on the other side, where the US dollar could in fact see a continued massive move to the downside. That remains to be seen as of yet, but looking at the basket of currencies that are measured up against the dollar, we can see very good strength along those other currencies, especially for the euro at this time. Thank you so much for joining us for our weekly market update. We look forward to touching base with you again next time.